Alrighty, Savings Scribe chat time, and this week we're talking to Savings.com.au journalist Denise Raywood, who has recently been looking a bit more into negative gearing, especially considering there's rumours that we might be seeing some changes to negative gearing and also capital gains tax as well, perhaps in the upcoming budget in May this year. Because, as we know, there have been calls over many years to change the incentives that make property an attractive investment. And as we know from history, Labor lost two elections in 2016 and 2019 when it proposed to limit the tax benefits. But in 2026, it seems that changes are on the agenda once again for the May federal budget. But this time, it comes amid the current housing affordability crisis that has seen Australia's median house price break through the $1 million barrier for the first time last month. Now, just some quick stats here for you as well. Just under 1 in 5 Australian taxpayers own an investment property, with the vast majority of these, around 71%, owning just one investment property. But yeah, as I said, journalist Denise Raywood joins us to discuss the possible changes to both negative gearing and capital gains tax as it applies to everyday mum and dad property investors. G'day, Denise. Thanks for joining us.
Good morning. Good morning.
Thanks for coming on, Denise. This has been such a big thing in the news cycle right now. So I'm really keen. Let's jump in and let's dive into the nitty-gritty details of it. But before we get there, do you have a savings tip for us?
Oh, I forgot the savings tip. Let me see. The salad dressing. I had some peanut butter that wasn't coming out of the jar very easily, so I decided to make a peanut butter-based salad dressing. So I put all my things into that jar, shook it up, and used the last scrapings of my peanut butter wisely. That is probably the worst savings tip.
I love that one, Denise, actually.
That's a great one.
Yeah.
And you brought that salad into the office, Denise, and it looked and smelt delicious. So that's a great savings tip.
Yeah, it was a really good salad dressing.
Fantastic.
So, just remember that when you've got those little scrapes of peanut butter that you feel guilty about washing out. It can be used. They can be used.
Yeah, so that's great to know, because that is a common issue for when I get to because I love peanut butter, and then when I get to the end, I'm just getting a knife and I'm basically just eating it with a spoon, just plain peanut butter, because I don't know what else to do with it. There's not enough to scrape on bread, and yet I love it so much I don't want it to go to waste. But yeah, I never thought. And salad dressing, that's another thing I tend to struggle a bit with. I've experimented with different salad dressing. I can never get them to taste great, so I might need to borrow that recipe off you.
Yes.
Sounds perfect.
Just keep it in mind. Sorry about the dodgy tip, but it's
no.
It tastes good.
I think that's a great one. I love that. Yeah. But yeah, we probably should get into this negative gearing stuff because it's turning into a cooking podcast. So what are some of these potential changes that are being talked about with negative gearing, capital gains tax? I mean, nothing's really concrete come out from the government, so it's all rumor and scuttlebutt. So, what are the potential changes, and what are the actual chances of these changes coming to fruition?
Well, it's interesting because, we saw before the federal election, and I think I've seen the clip multiple times on various media of Anthony Albanese ruling out any changes to the capital gains tax or negative gearing. But, it's a big majority in Parliament that Labor has, and I guess in some ways they're using that, and they've got a bit of leverage with, as we've said, the housing affordability crisis showing no sign of abating, really. And I think maybe there is a bit of an appetite in the electorate for maybe some changes that, probably in the interests of giving young people a fairer go in the housing market. And I think, a lot of mum and dad investors, and they are the ones, 71% of, people who claim a negative gearing concession just have one investment property. So, mum and dad investors have kids, and, maybe they're thinking, well, things have to give a little. Of course, there'll be others who don't see it that way and don't like changes. So we've sort of seen suggestions that perhaps negative gearing be limited to just 2 investment properties that a person owns. So that sort of leaves a lot of our property investors out of the loop. It won't affect them. There have been, changes to negative gearing once in the past. Basically, I should say what negative gearing is for those who aren't quite clear. Negative gearing allows property investors to claim the losses on their rental property against their taxable income. So it basically provides them a tax benefit. They will pay less tax. So it includes the interest that's being paid on an investor loan, property rates, maintenance, insurances, body corporates. And you have to have a loss on your investment property to benefit from negative gearing. If you don't have a loss, your property is positively geared, so that won't affect you at all. You will just pay your normal tax bracket rate on that extra income that you use on top of whatever other income you've got going in. So it is on losses. There was a change in the mid-80s where the Hawke-Keating government decided that negative gearing wasn't that fair, and it decided to limit losses just on rental income earned and not on other income, so wages or other income that property investors might have. And so if it saw at that time quite a few investors thinking it wasn't worth their while and getting out of the property market. It lasted for about 18 months, that experiment, and rents started to go up in most Australian cities. And it wasn't all Australian cities, which suggested there are other factors at play in this. But it was a bit too scary for the government at the time to contemplate. So they changed the rules back and they haven't really shifted ever since. So it will be interesting to see whether that comes in. The one that's probably being talked about more, and particularly in light of the upcoming May budget, is the 50% capital gains tax discount. So that was a Howard government call in 1999, and basically it just replaced a more complex system. So there always was a bit of a discount that was claimable via tax on capital gains, but it was a complicated formula. It basically separated what was a real capital gain and what was just driven by price inflation. So it was a complicated calculation that accountants and the tax office had to do. So Howard made that much easier by saying, right, we're just going to make it a 50% capital gains tax discount for any asset that is held longer than 12 months. So that includes not just property, it's also shares and any other investment. So it hasn't been made particularly clear if we change that capital gains tax discount. Do we also change it for all investment classes, or are we just going to change it for property? And it has just been suggested by some quarters, no, just apply it to property because that will help young people get into the market, create more housing stock. So that brings its own issues as well. It sort of sets different investment classes on different playing fields. An implication I thought of that is a lot of mum and dad investors understand property investment. You buy a house, it tends to go up in value in Australia. I think a lot of everyday just mum and dads will be a bit more reluctant to invest in shares and other investments. They see them as higher risk. They don't quite understand, markets or feel not confident navigating that space. So, playing one investment class off against another, that could have some implications, more long-term, of course. But yes, it's a very interesting time. There's been a lot of discussion in the media from lots of different commentators giving their 2 cents worth as to what should happen and will it happen as soon as the May budget.
It's been really interesting. I guess one thing you mentioned there about other investment classes like shares versus property. A lot of people find property really attractive because you can leverage it to such a high degree. You can take out a mortgage for, 90, 95% even of the property's value. It's a more stable asset class historically, so people seemingly seem more comfortable borrowing against that property and then holding debt against an investment that they hope will go up in the future. And of course, they can any interest that they pay on that loan can be deducted from their taxable income. So it gets really complicated when we start thinking about it too much. But do these changes, Denise, do you think they'll be applied retrospectively to people that if they come about, to people that already own property, or will they be implemented for those who buy it going forward?
There's been a lot of discussion on that, and interestingly, over these, probably today's the last day of it, the Business Council of Australia has been hearing from, some of our great economic and tax brains, and most of them agree it shouldn't be applied retrospectively. I think Bill Kelty, who's a very respected Labor Party figure, an old ACTU boss who was quite instrumental in helping the design of the modern Australian economy in the Hawke-Keating era, has said that he doesn't believe in retrospective taxes. He finds that unfair and a bit of a short-term grab for cash, just for government expenditure. And he said it needs to be part, if it's going to be changed, it has to be part of a longer-term tax reform. He's also called for bringing down personal tax rates, which he said penalise young people working. He said that the top tax rate shouldn't be any more than 39%. It's 47% at the moment. And then we've got the 2% Medicare levy on top of that. It's interesting. Most people are saying that the capital gains tax discount should be just lowered. Some are suggesting between 20 and 30%. 33% is a figure that's been bandied around a lot. And they're saying that it shouldn't be grandfathered. It should just come in from now. And that will be very interesting to see whether that's the case as well, because that will mean that there'll be some investors perhaps less willing to invest in property. And that means also that they may be less willing to invest in new housing stock, which is what the housing market needs. So to sort of combat that, there's been suggestions perhaps that this capital gains tax discount adjustment should only apply to investors with established homes, and the 50% should remain for those who are going to build new housing supply for investment. That may be a fair way of not seeing such a great hit to housing supply. As we saw when the Hawke-Keating government just made that relatively small adjustment to negative gearing, investors are sort of quick to flee. They look for where there's better prospects. So that could certainly happen if it was applied across the board.
Yeah, I'm glad you mentioned that there on the potential impact on supply, because that is, of course, what some housing industry groups are coming out saying. That the risks with tampering with the current sort of incentives is getting the investors in to stimulate the new supply in the market. I think I saw some stat that they were sharing. I think it was the Housing Industry Association saying something like 70% of the people that buy the new dwellings in those high density apartments being built tend to be investors, and so you can't really get developers to build these high rises without that investor market being there. So does that run into problems with the government's housing accord? Trying to get 1.2 million new dwellings built by 2029, I think it is, but if there's that compromise there where if they retain that 50% discount for new dwellings, you can then sort of appease that segment of the market as well and ensure that you're not preventing new supply. But another thing I've just been thinking of is just the grandfathering thing. It's I can understand why you grandfather it to prevent like a mass fire sale that happens before the discount goes away, and people are all just trying to sell their assets, and just all the issues that would cause in the market, and the stability of the whole financial system in Australia, given that so much of it is guaranteed by the housing. But at the same time, you see, by grandfathering it, then that benefits existing investors. So those older generations, boomers, Gen X, who have gotten into the market, and then this sort of change to capital gains tax just only ends up harming the younger generations that have had it so bad for so long, which is ironic given that it tends to be younger people that want these changes to happen, and yet it's probably going to impact them the most. We've covered a lot, so I don't think I can ask any more questions on this, Denise, but you've already basically answered and touched on all the main points. But as always, a pleasure hearing your insights into this one. And any readers that listeners that are interested to become a reader, You can read Denise's explainer on negative gearing in general, but also what would happen if negative gearing was banned or tampered with. You can find that article on savings.com.au. Denise, thank you very much for joining us. Talk again
Always
soon.
a pleasure to be on the pod.